Hey there, and welcome to Real Estate Unpacked. So here's a question. When someone asks you what's happening in the real estate market right now, do you have an answer? Like a real one? Not the vague, it's a great time to buy, or inventory is tight stuff. I mean the kind of answer that makes people lean in and go, wait, how do you know all this? That's what this podcast is about. Every week, we are going to unpack what's actually moving the real estate market. The trends, the data, the economic shifts that matter. It's the stuff worth knowing. Whether you're a real estate agent who wants to be the go-to advisor in your market, or you're just trying to figure out if now's the time to make a move, this show is your weekly briefing on what matters right now in real estate and why. So let's unpack it. Welcome to 2026, new year, fresh start. And if you're a real estate professional or someone thinking about buying or selling in today's market, you're probably wondering, what kind of market are we walking into? If you've been watching the housing market lately, you might feel like you're getting mixed signals. Prices are barely moving, rates are down but still high, inventory is up, but homes still aren't exactly flying off the shelves. So as we kick off this new year, let's cut through the noise and figure out what's actually happening. Because if you're going to make smart decisions in 2026, you need clarity, not confusion. So let's unpack it. According to the S&P Case-Shiller Index from October, national home prices are up just 1.4% year over year. To put that in perspective, inflation over the same period was around 3.2%, which means in real terms, home values are actually declining because they're not keeping up with inflation. 16 of the 20 tracked cities saw prices drop month over month. The winners? The Midwest and Northwest cities like Chicago and New York. The losers? Sunbelt markets like Tampa and Phoenix. Now, keep in mind, this is not a crash, just a little slowdown, a stall. The market is catching its breath after years of frenzy. So for agents, this is the data you need when a seller asks why their home isn't getting the offers they expected. It's not your marketing, it's a national trend. Real prices are declining and buyers know it. Now here's where it gets interesting. Mortgage rates have dropped nearly a full percentage point from a year ago, from 7.10% to 6.19% as of this week. That translates to real savings. On a median priced home with 20% down, you're looking at about $200 less per month than you would have paid last year. Inventory is up 12% year over year, and prices are flat. Rates are lower. On paper, this should be great news for buyers. But here's the problem: down payments. Even with better conditions, it still takes the average buyer about 7 years to save for a down payment, double what it took before the pandemic. Yes, that is down from the 12 years it took in 2022, but it is still a massive barrier. The homeownership rate has fallen to 65%, and that is the lowest since 2019. Now, for buyers, if you have been sitting on the sidelines waiting for the quote perfect time, this is what improvement looks like. It's incremental, not dramatic. Lower rates and more inventory won't last if you're still 2 years away from saving a down payment. And if you do manage to buy a home, there's another layer to affordability that doesn't show up in the mortgage payment: insurance and property taxes. Insurance costs are projected to rise 8% in 2026. Property taxes, well, they're up 30% in some areas. For homeowners in disaster-prone states, think Florida and California, these non-mortgage costs are becoming a serious strain. In fact, there is a correlation between rising insurance costs and spikes in mortgage delinquencies. The cost of owning a home is no longer just about the mortgage. So for agents, when you're running affordability calculations for buyers, don't just show the principal interest. Show the full picture. Show taxes and insurance as well, especially if you're in a high insurance or high tax market. Buyers need to budget for the real monthly costs, not just the mortgage payment. And for sellers, if you're thinking about moving, factor in what your insurance and taxes will look like in your next home. What looks like a lateral move on price might cost you significantly more to own. Now, if you are hearing all of this and thinking, wait, aren't we heading towards another housing crash? Let's address that. Mortgage debt as a percentage of GDP is still well below where it was during the housing bubble. Lending standards are much stronger. Most homeowners have significant equity, were well qualified when they bought, and locked in rates they could afford. There's no wave of distressed sales coming, no cascade of foreclosures. This market isn't fragile, it's just expensive and slow. So for agents, when clients bring up 2008, this is your response. The fundamentals are completely different. This is a story of affordability and adjustment, not systemic risk. So What does all this have to do with economics? Because I love throwing in economic concepts on these podcasts. Allow me to introduce a deceptively simple idea that's quietly doing a lot of work in today's housing market: the time value of money. At its core, the time value of money says this: a dollar today is worth more than a dollar in the future. Not because money is magical, but because of two very human realities: opportunity cost and inflation. If you have a dollar today, you can do something with it. You can invest it, earn a return, reduce future borrowing, or lock in certainty. That's opportunity cost, what you give up by waiting. And because prices tend to rise over time, that same dollar in the future simply does not buy as much. That's inflation. Interest exists to compensate for both of these forces. This idea isn't abstract, and right now, it is sitting at the center of this housing conversation. So let's connect this to what we're seeing in this week's headlines. We just got new pending home sales data from the National Association of Realtors showing a meaningful pickup in buyer activity. That matters because pending sales tend to reflect future demand, not past conditions. Now rates, well, according to Freddie Mac and Mortgage News Daily, the 30-year fixed rate is hovering in the low to mid 6% range, lower than last year, but still well above pandemic lows. Put those together, and here's what's really happening beneath the surface. Buyers aren't just reacting to waits, they're reacting to the cost of waiting. That's the time value of money showing up in real life. So here's the decision many buyers think they're making. Do I buy now at 6.2% or wait for rates to drop? But the time value of money reframes that question into something more honest. What does waiting actually cost me? And what might it save me? Because every month you wait has a price. Rent paid that builds no equity. A purchase price that may be higher later. Lost appreciation if prices rise again. Lost certainty in an improving demand environment. At the same time, buying now does have its own costs. Higher borrowing costs today. A payment that might be refinanceable later, but that's not guaranteed. What the time value of money forces you to confront is this: you are always paying for time, either upfront or later. And importantly, that payment isn't just financial, it's psychological, it's opportunity, it's risk. This is why we're seeing buyers step back in even without perfect conditions. As one of the articles this week pointed out, affordability isn't just about rates, it's about down payments, price expectations, and confidence that waiting will actually help. When prices stop falling and inventory tightens, the expected benefit of waiting shrinks. The time value of money explains why markets often turn before the headlines do. Once buyers start believing that waiting may cost them more than acting, behavior changes, even if rates aren't ideal. Now let's talk about the other side of this equation. If you're a homeowner who locked in a 3% mortgage a few years ago, the time value of money is working in your favor. That low-rate mortgage isn't just cheap debt, it's an asset. You're paying back tomorrow's loan balance with future dollars that are likely worth less than today's. Inflation quietly does some of the work for you. That's why so many homeowners feel stuck, not emotionally, but mathematically. And that too is the time value of money shaping behavior. So here's the real takeaway. If you're considering making a move in today's market, buying, selling, or even deciding to stay put, this is where working with a real estate professional actually matters. Not someone who predicts rates, not someone who pressures you to act, but someone who can help you do the time value of money math for your situation. Because the right question usually isn't, should I buy now or wait? It's, what does waiting cost me and what might it save me? And the honest answer might be, yeah, waiting makes sense, or no, the cost of waiting is higher than it looks. Either outcome is fine. What's risky is skipping the analysis entirely and making a decision or delaying one based on vibes, headlines, or hope. And if you are a realtor listening to this, this is a powerful way to reframe conversations with hesitant buyers. Instead of pushing forward or defaulting to just wait, you can say, hey, let's actually run the time value of money calculation for you and see what the trade-offs look like. Because once you do the work, you're no longer guessing. You're choosing with clarity. And in a market like this, that's the real advantage. So to wrap up today's episode, here's what you need to know this week if you're a realtor. 1, Price the reality, not the memory. National prices are up just 1.4%, lagging inflation. Sellers anchored to 2021 values need to see the data. It's a national trend, not your market. 2. Affordability is improving, but slowly. Rates are down nearly a point from last year, and inventory is up 12%. Use this to re-engage buyers who went dormant in 2023. Number 3, go beyond principal interest in your buyer consultations. Insurance and property taxes are rising fast and correlating with delinquencies. Show clients the full cost of ownership, especially in high-risk areas. Number 4, you're not selling against 2008. Mortgage debt levels and lending standards are strong. When buyers or sellers bring up crash fears, use the fundamentals to calm the conversation. And number 5, frame the decision as a time value of money trade-off. Buyers aren't just choosing a rate, they're weighing the cost of waiting, like rent and rising prices, against the costs of acting now. Help them see both sides clearly. Now, for buyers and sellers, if you are buying, rates are the lowest they've been in over a year. That $200 a month difference adds up to quite a bit over 30 years. The down payment is still the biggest barrier. If you are close, this is a better window than we've seen in a while, and you might be surprised at how much sellers could be willing to help you out and fill in the gap. And budget for the full cost of ownership, meaning your mortgage plus insurance and taxes. Don't get house poor on paper-thin margins. Now, if you are selling, prices are flat nationally with, just like we've said, a little bit of growth, and real values are declining because they're not keeping up with inflation. So if you're waiting for 2021 prices to come back, the data says that's not happening soon. Buyers have more choices now. Your home needs to be priced competitively from day one. If you're moving, model out your next home's insurance and taxes. They may be higher than you expect, even on a similarly priced home. So that's this week in real estate. The market isn't booming, not crashing, just adjusting. Prices are kind of flattening, and affordability is improving, albeit slowly. And the real barriers aren't just mortgage rates anymore. They're down payments, insurance, and taxes. This week, when someone asks you what's happening in the market, you've got a real answer now. Not a vague one, not a cheerleading one, a real one. And that's what we're doing here every Monday, giving you the intel you need to be the real estate economist of choice in your market. If you found this useful, hit subscribe. That way, every Monday afternoon, you'll have this week's market briefing ready to go. I'm Jennifer Templeton, fellow realtor and broker associate with the Crest Edge Group at Keller Williams Rockwell. And if you found this episode helpful, or you're buying or selling in the DFW area, or maybe you're an out-of-market agent looking for a trusted local partner, our group would love to be your real estate resource of choice. Visit thecrestedgegroup.com/unpacked for next steps. Thanks for listening, and I'll see you next week.